Good afternoon, everybody. Welcome to the EMEA Euro-Mediterranean Economist Association webinar on the role of debt on climate finance for the Mediterranean and for Africa. I think this topic is very important nowadays because of all what we've been hearing about increasing debt in low and middle income countries, but also in developed countries. And this is actually the legacy of the COVID pandemic and other aspects, socioeconomic aspects, which have really led many countries to very high levels of debt, and at the same time, all the needs, financial needs for countries to deal with climate risk mitigation and adaptation. So what we know about debt and climate finance is that, first of all, we need debt sustainability. And in fact, many countries in Africa and also parts of the Mediterranean region are facing, as I mentioned, high levels of debt, which limit in reality their fiscal space to invest in climate adaptation and mitigation. And this will really reduce their capacity to deal with the climatic, in fact, challenges that they are facing because they simply divert resources away from dealing with climate change investments that are needed. And then what they have to do practically is to service their debt with very little resources. So debt sustainability becomes a real priority for dealing with these aspects of debt. Now, another aspect is related to the fact that accessing to climate finance becomes extremely crucial in these regions to implement and to develop and implement climate adaptation and mitigation projects. Time is running, the clock is running very, very fast. We've seen that in the COPs, we are very, very far behind from the financial needs that these countries are facing. And I think what we are also seeing that the current global financial system is putting some African and Mediterranean countries within the low and middle income category at a disadvantage. Why? Because of the higher perceived risks and lower credit ratings. And these credit ratings are even deteriorating over time, which in fact is leading to much higher borrowing costs for them, which makes them even further at a disadvantage. The other thing is related to the conditionalities, and when we deal with the debt instruments, and in reality, some climate finance mechanisms come with strict conditionalities that may not always align with the priorities and also capacities of recipient countries. In fact, innovative debt instruments like, for example, the green bonds, the blue bonds, or debt for nature swaps, are all being in fact explored, but not widely accessible or sufficiently tailored for specific needs of this region. So, in fact, we are experiencing, I would say, a growth of these financing instruments, but we do not know yet whether they will serve the purpose of enhancing the sustainability or debt sustainability of these countries, but at the same time, whether they are really the appropriate mechanisms of debt instruments to, in fact, deal with the challenges of climate change. Now, also, those countries in Africa and the Mediterranean are very vulnerable to the impact of climate change. We've seen it over the last couple of years, which in fact exacerbates existing economic and social challenges and lead to further increasing debt as countries seek really to recover from those climatic-induced damages that are coming from enhanced frequency of these climatic-linked events that we've seen over the last couple of years. Another issue which has been widely discussed is equity and justice. I think there is an ongoing debate about the equity of the current climate finance system, which calls for much more, in fact, sometimes grant but also debt cancellations in many countries to avoid further indebting vulnerable countries. But these debt cancellations, they come with dire conditions, because then the market will not allow those countries anymore for several years to access to liquidity. So this is also another issue which one has to think about. But then moving from loans to grants also has its own incentives, which are probably the wrong incentive for certain countries. Now, the principle of climate justice also demand that those who have contributed least to climate change over the years, this is also many countries in Africa and Mediterranean region, may not bear an undue financial burden in addressing its impact. So it means that we should think about the historical, contribution of those countries, and then have an equitable and just approach for the transition that we are aiming at. Now, there are several initiatives that have been undertaken by the international community over the couple of years since the COVID and even before, and these are all related, for example, to the special drawing rights or the SSI, common framework now for debt treatment, which is a framework beyond the SSI. It doesn't seem to work clearly. Why it doesn't seem to work? Because, okay, these are aspects that are extremely complex to deal with. And then sometimes you need to have full agreement between all countries that are in reality the creditors of those countries that are indebted. So we've seen, in reality, we've seen several cases which even created some adverse results, like, for example, the case of Zambia, to name a few, but there are many other countries, in fact, which all this instrument and all this, I would say, initiative have not yielded to the results expected. Now, also, they wanted to raise the issue of transparency. There is still lack of transparency on the use of debt, particularly with the, I would say, public and private creditors, and also the lack of proper management and use of funds. So, of course, all of this will have to be an integral part of our thinking about sustainability of debt. And also, beyond this, how they can be used, or it can be used for financing climate mitigation and adaptation. So, of course, all of this we will also continue seeing in the international settings. Nowadays, we have the G21, because the African Union now is becoming a partner of the G20. And I think this might also bring another perspective from the African region to the G20 thinking, and this is happening currently in Brazil. Now, Euro-Mediterranean Economies Association has launched for several years now, since 2022, the Debt Transparency Initiative, on the basis of which also we collaborated with initiative for this webinar today. And our idea is to use data and research to enhance the knowledge about debt-related issues, not only in terms of debt sustainability, but also for climate finance use and so on, and mainly for low and middle income countries. So our webinar today is very timely, especially that many institutions around the table today have been working restlessly for this topic. And then our idea here is to explore where are we in terms of the trends in debt, and what are the initiatives, what has been done so far, what are the discussions, and what are we expecting from the G21 as we talk. I mean, it's happening in this week, in fact, and next week already the first meetings. So in this webinar, we will try to, in fact, discuss some work we have been doing since a couple of years now on debt and role of transparency, and how we could develop mechanisms to stabilization and recovery, and also sustainability for Africa. We are now working on a policy paper on this on these topics, and my colleagues here at EMEA will present some of our ideas. So without further ado, I would like to welcome all the panelists today for this very timely webinar. And the idea is really to share the experiences, to share the research, to understand a little bit what we need to do to enhance views, at least to better understand how that should be used for climate finance, not to push those countries, specifically the low and middle income countries, into further unsustainability and economic and social hardship. So let me first start with my colleague, Sandra Shalita. Sandra, she's a research fellow at the Euro-Mediterranean Economist Association. She is a collaborator specifically on this work on debt for climate finance and for recovery and stabilization and sustainability for Africa. She is also a professor in Lyon Business School, and she has published several papers and on financial systems. So let's start with this. Sandra, the floor is yours.
Thank you, Reem. So I will share my screen to present this work that we've been doing. So, okay. So thank you, Reem, for this presentation. And well, you introduced clearly the topic, so we'll try to go directly to the core issue, just to make sure you have. Okay. So what we propose is basically a blended financing framework for recovery and accelerated sustainable transition. This policy paper will be published soon, and it's co-written with Reem and Sarah Ronco. So basically, as Reem just said, countries are balancing between different challenges, and especially for today's topic, we have more and more government debt that are due to the COVID-19 crisis, to the increasing number of conflicts that also impacted the prices of raw material. Also, the context of increasing interest rate or increased the cost of financing. And we observe also a lack of concerted effort to reduce the debt burden in the countries. And on the other hand, we have increasing urgency for climate change mitigation actions. So we need to go for a sustainable transition, and given the burden of the government debt, it will put further pressures on the low-income countries and low middle-income countries. And also there's a colossal financial needs for adaptation and mitigation for climate change, and more importance for integrations of the SDGs. So if we want to overview the key figures for our target region, basically what we observe is that we have a stable level of debt for middle-income countries, however, an increased level of debt to a gross national income, especially for low-income countries. Also, we observe this for the MENA region and for the sub-Saharan Africa region. Also, we have different types of lenders. So the main lenders are institutional lenders worldwide, but if we check for the MENA, we have also an important role for the UAE, and for the sub-Saharan Africa, we see also an important role of China and France in providing debt. Also, well, the African and the MENA region is highly indebted, but also with high risk, with high default scores. So this shows a high level of debt vulnerability. To address the debt vulnerability, there was the launch of the DSSI by under the World Bank Group to address the debt vulnerability for the poorest countries in 2020. It was aimed to enable the freeing up of some fiscal space to mitigate the health crisis and its consequences. The implementation included monitoring of spending, promoting public debt transparency, and ensuring prudent borrowing. The main obstacle for this initiative was the lack of debt transparency. And basically, this has impacted the little success to attract solid participation of the private sector. So to go beyond this, so in a context of absence of global comprehensive financing resolution framework for sustainable transition and the high chances of systemic debt, we will have basically a long and painful transition that will impact also the SDG objectives and the net zero objective. So basically, there is a need for innovative solutions for stabilization and recovery. So basically, what we propose for this is under the framework that was proposed by Al-Tuwaijiri and IADI 2021 to call for sovereign debt registration repository, so the initiative of the debt transparency platform, to have more transparency on the government debt. We complement this proposal today with basically a public-private SDG compliant financing fund as a part of the economic recovery plan. This initiative allows to restructure the existing piles of debt and interest and finance a sustainable recovery while accelerating the transition toward the SDG and the net zero. How it can be implemented? So the proposal would suggest a mechanism that can take a form of a partial guarantee between 40 to 60%, issued by the Resilient and Sustainability Trust that was established by the IMF in 2022. So basically, it will allow to issue recovery, resilience, and sustainable transition bond at lower interest rate, basically to finance the recovery plans post-COVID and the sustainable transition to 2050. So this trust, the trust has conditions that are fully aligned for eligible countries to engage in reforms for sustainable transition and to achieve the net zero scenario. And so the main condition to get access to these bonds is to use predetermined percentage of the proceeds to finance the unpaid debt. And the remaining 80%, let's say if we take 2080, the scenario, the 80% will be allocated to recovery and sustainable transition. There is a need to respect very strict monitoring clauses and use of proceeds to and the use of the proceeds to achieve the SDG goals, and also to publish the debt issued and to have transparent information that can be published at the repository of the OECD. And basically, these terms and conditions are pre-agreed upon the country and the IMF. So basically, the proposal aims to have a collaborative approach between the private sector, the IMF, and the country in difficulty. For the private sector, since the IMF, the RST will provide this guarantee, they will be able to provide affordable liquidity for the countries in times of need. And basically, the private sector will have incentive to invest in the RRST bonds with reduced rates. For the IMF, basically, they should work in close coordination with the private sector, and it allows them to use the funds that are based on the SDRs to leverage their capacities to finance and monitor the issuance of debt and their use. And for the country of difficulty, it will be a co-designed approach that answers to the specific needs of the countries. As Reem said, the needs are sometimes different, so it allows to align the objectives And on the long run, these countries who are in difficulty can access to capital markets, enhance the level of transparency, hence corruption, and to reach the SDG and net zero objective. So basically, the approach is to have a win-win-win approach for these three parties for a better debt sustainability. Thank you.
Thank you very much, Sandra. I think you gave I would say, the work that we've been doing clarity. In fact, it's even much clearer even to me now. Thank you very much for this. I think what is important here is to also lift conditionality on the countries with debt transparency. So it means that the countries, they have the responsibility to issue their bond with the guarantee of the, of course, of the trust fund, but also with the support of the private sector while they commit to full transparency on the use of their debt. So that's the whole idea, and then lift on them all the, I would say, the complex web of conditionalities that they've been imposed to on, for example, all these bailout plans of the IMF, which really restricts their capacity to develop and to ensure that they are on a sustainable path of growth. Thank you very much, Sandra, again. Now I would like to move directly with our colleague, Martin Kessler. So Martin, he is the Executive Director of the Finance for Development Lab. So this is really Financial Development Lab. So you are thinking on innovative solutions for development finance, for the low and middle income countries, surely. And we are very happy to be also partners with you for this lab. And we had the chance to discuss several times on the debt transparency issues. So you, Martin, you are an economist. You have done a lot of development finance cooperation. You worked for the OECD. And also you worked in different think tanks, Bruegel, Peterson Institute of International Economics in Washington, D.C., and you have worked in the World Bank. So you are really outside, I would say, an insider of all these development. You know very much, the intricacies of debt, and you had the chance to work with great colleagues who have contributed widely to development finance issues. So, Martin, I know that you have developed your proposals for the African countries tour and for low and middle income countries. So the floor is yours. Thank you.
Thank you so much, Rim, and thanks a lot for this initial presentation. I think that's, clearly, I think there's a shared diagnostic that the weight of debt and debt service is high, is weighing on the options of developing countries, especially low-income countries, but and lower middle-income countries that have started to borrow on markets in the 2010s and have done so increasingly until COVID, basically. And that's now that we know that there's a huge need in external finance for the climate transition, of facing both the weight of debt service and those increasing needs. And this comes at a time where the borrowing conditions have become much harder. They're improving now since the end of 2023, but they're still very high, especially for countries that have lower ratings, as you were mentioning in your initial introduction. So the proposal that we make with my colleagues Ishaq Diwan and with Vera Songwe tries, in a word, another way to try to respond to the challenge, and I think that could be somewhat complementary to the work that you have been doing with Sandra. I think the first thing that we want to highlight is that while there's a lot of talk about the risks of debt and rising debt, and which it's perfectly true. Actually, external debt has been rising, especially in low and lower middle income countries, but is still well below the levels that were when the major debt crisis occurred in terms of levels. What has been rising clearly is domestic debt, which speaks to development of financial markets, the domestic financial markets. But on external debt, the levels are still reasonable. And there's a lot of differences across countries that are really depend on financing condition, exchange rates. There's a lot of things, exports, etc. Exposure to commodity risk. But I think beyond those very broad differences, I think what we want to highlight is the fact that the levels of external debt are still reasonable, have been rising, and are should be taken as a concern. But what is really concerning is two things. First is the rising debt service, and then the fragmentation of borrowers. And I think that's where your point about debt transparency is really important, because there's a lot of fragmentation. There's new borrowers, fragmentation of lenders, new lending sources, emerging official lenders such as China, but also bond markets that are not part of the restructuring system as it has been set up in the 80s and the 90s with the Paris Club, and a strong coordination with banking groups. And we can see the rise of bonds, especially in sub-Saharan Africa, and everywhere, but it has been especially rapid in sub-Saharan Africa, with consequences in terms of the way debt service is due. Which it is with bonds, it is especially those bullet repayments that are often falling in 1 year, can be spread out a bit, but are often much more chunky, occur in 1 year, are very difficult to reimburse when they come as a whole. And that's been especially concerning when it's hard to borrow abroad, when market conditions are difficult. If you need to borrow, especially when you have high debt service in one given year, then you can face this liquidity gap, which means that even though you could be solvent in different setting if markets were open, because external conditions, because the Fed has been rising rates, because the ECB has been rising rates, etc. Because of inflation in developed countries, you face possible default, whereas you could be solvent with different external conditions. And then we try to highlight these risks with where we set up at the lab with some colleagues a small model that looks at those dynamics, looks at various financing conditions, and find that debt service is high compared to the government revenue. So it is eating an increasing share of government revenues that is not spent on development goals, and that will continue to rise and will continue to be high, especially if rates remain high. And that's true for all income categories, but especially lower middle income countries, those that have gone to market the most. On the other side, if you look in terms of stock, yes, it will continue to rise, especially in the pessimistic scenario where rates are high. But as a share of GDP, it depends a lot of countries, obviously, but as a share of GDP, it remains relatively manageable. So I'll go fast because I'm close to 7 minutes, but I think what are the responses? I think the one is first for countries that have high level of debt stock, cannot in most scenarios reimburse. You need a better coordination mechanism across creditors, and that's a common framework. I think we all know, and we all agree here that it hasn't been working as it should have. It's slow. It's hard to integrate different procedures. It's hard to integrate the private creditors to agree on what is comparative treatment. So that's one important piece of the puzzle for countries that are at high risk of their distress. But for others, I think what we emphasize is the fact that there will be new sources of financing that are coming. The MDBs are going to increase their lending, but they're doing that slowly. And what they need is now. So what countries need is an increase now. And so what we're proposing is a bridge to this, a bridge between what MDBs are doing, multilateral development banks are doing, which is to slowly increase their lending capacity in 5-10 years, and to bring it to now. How do we do that? So we have this proposal to go fast. It's a way for existing creditors, bilateral creditors, and private creditors to scredit their debt, to wait a little bit more to be reimbursed in exchange for a surge in development finance from MDBs from the IMF. That countries would commit through an IMF program, but also through own development plans to invest, especially in climate resilience, which would allow to maintain high rates of growth. Ultimately, debt sustainability is whether your rate of growth, your ability to repay, grows faster than the interest rate. So that's in a nutshell what we're proposing, and so it's a way to bridge from the long term to the short term. One thing to note is that in the past 2 months, several countries, especially in sub-Saharan Africa, have been able to come back to markets and to borrow. Does it solve the problem? Not really. It does help, but especially for liquidity, it brings new money to the table. But they have done that at very high rates. Kenya has borrowed at 10%, about 10%. Côte d'Ivoire, about 8%. So those are rates that are very high. It's risky. It's also only available for countries that have, in the case of Kenya, for example, also use a lot of IMF borrowing, a lot of borrowing from multilateral development banks that reassures the markets so that they were willing to lend, but lend still at very high rates. So there's a role for credit enhancement, and I think that matches very well what you described in your proposal. I'll stop there to play ahead of time, but I think this match between new credit enhancements, lengthening and smoothing the debt service, and allowing for new surge of lending, affordable lending from official sources, is one key to bring climate finance and to reduce the stress on debt.
Thank you, Martin, for your assessment and proposals. And I think it goes quite hand in hand with what we are also proposing. But just want to be sure. So what you're saying is this is not a restructuring plan, or this is a formal restructuring plan.
So indeed, so this is not a restructuring plan in the sense that that what is asked from other lenders is rescheduled. So they wouldn't have a loss. Restructuring is usually designed refers to a situation where creditors have a loss on the value of their loans. Here, I think countries require rescheduling, which means a lengthening of the repayment period. But that would come in exchange in technical terms. It would be neutral in net present value. It would and so it wouldn't constitute a formal restructuring.
But then, as soon as you're saying to the creditors, you are going to restructure the terms of payment over a longer period of time, do you think this wouldn't have an impact on the capacity of those countries, the borrowers, potential borrowers, to borrow further from the market, and the new borrowing cost, if they would like to borrow more? So the new borrowing cost will be much higher, no?
Yeah. So what countries are facing now is much larger outflows in private money than new loans. So in a way, it's already facing that problem because of high rates. higher risk spread, premium. And so they're already either excluded or borrowing at very high rates. So, to avoid that, to manage its situation, instead of repaying and so having a lot negative outflows, a lot more money coming out than is coming in. What is happening now is that money coming out is more or less mitigated by money coming in, but coming from multilateral development banks, which means that official money is repaying either private creditors or official bilateral creditors. It's not a great way to do development. Basically, there's very little that is coming in and that is invested. I think what we're proposing is that for the years, which depending on how long it takes to manage inflation in developed countries, but could be a couple of years, 3 years. For those years, yes, probably you would have a lot less new loans from creditors, but you would be able to have a surge in multilateral development finance, coming from the World Bank, the African Development Bank, that would not be used to repay all creditors, and that this efficiency of aid that needs to be improved. That for now is really deteriorated, and we see that in the numbers in 2022. Basically, for low-income countries, every dollar that has been sent to low-income countries has been going out, and that means that no new loans is invested. There's the loans from MDBs is basically used, so the money is mostly fungible. Sometimes it goes to projects, but in general, in aggregate, it's been used to repay creditors.
Yeah, very clear. Thank you very much, Martin. We'll continue the discussion with everybody later on. Thank you for this. Our next panelist is my dear colleague, Mohammed Labidi. Mohammed, he's professor of economics. He is advisor to the Arab Planning Institute of Kuwait. Muaz has huge experience on things related to debt, banking sector, monetary policy. He has been sitting in the board of the Central Bank of Tunisia, Stock Exchange. He has been also a member of the Stock Exchange Index Committees at the Tunisian Stock Exchange. He was also a member of the National Council Competition. He advised the Minister of Finance in Tunisia up to 2018. And also he has advised the president of the government in charge of the economic issues from March to September 20 in Tunisia, of course. Now, great experience. Of course, you've been facing a lot of difficulties because, for example, Tunisia, not only Tunisia, but many other countries are facing these difficulties. And each time one looks at the numbers, say, okay, this is the time for economic collapse. But so far, things have moved, I would say, slowly. But we don't know. I mean, this is all luck produced factors, which interestingly enough, we are all looking at the case of Tunisia. We've seen even a report from some credit rating agencies, which are quite alarming. Anyhow, so Muaz, I know that I asked you to give a view on the Arab countries. So please, you have the floor, and we can discuss afterwards.
Thank you so much, Reem, for the presentation. And the focus of the topic is about the debt sustainability and the climate variability. Just I shared. The context of the situation in the Arab region we have three specificity of the Arab region. Arab region is one of the most highly indebted region in the world. Excuse me, just to. close this. The second specificity is Arab region. Arab region is far of being a homogeneous area. We have a country with comfortable fiscal space and other with limited fiscal space. And the third specificity in Arab region is an area affected by the vicious circle of climate change and debt distress. I remind you the characteristic of the Arab region. Arab region are largely exposed to climate change, as seen in the figure. All the frequency of disaster in the region is very high. The region is affected by water scarcity. Iraq is the only countries with comfortable position. The second is Iran is not in the region, and the majority of country are under the absolute water scarcity threshold. Arab region, many Arab countries are in the highest default risk. In the 4 Arab countries are in the top 20 of the highest risk: Egypt, Tunisia, Jordan, and Bahrain. Non-concessional climate finance remain the main funding instrument, and which complicate the situation of financing. Climate, we can see a gap between the financing needs and the financing required for climate resilience. Another characteristic, the capacity of government to transform growth into tax revenue, that can be explained by the bad governance or the deficit of good governance in public finance, and finally, an insufficient monetary space. The high level of inflation impose a high level of interest rate, which penalizes the investment. The second point is the interaction between climate variability, debt distress, and the climate vulnerabilities. We have the double causality. Debt vulnerability exacerbate the climate vulnerabilities. With the high debt external debt levels, high public external levels, more resources spent on debt servicing, which increase, which generated more difficulties to invest in environment transition and more difficulties to respond to the challenges of damage caused by climate change. Also, high debt level leads to an over-exploitation of natural resource to increase export and revenue. For example, in the region, the over-exploitation of hydric resource to export fruit and vegetables leads to could generate a rise of water scarcity, and the result, more the climate vulnerability in the regions. On the other side, climate change impacts debt distress. The greater climate vulnerabilities increase the climate risk premium, and which generate a high cost of capital and a high debt services, which precipitate the the debt distress. Also, the climate vulnerabilities is likely to impose the compensation for damage caused by climate physical risk, which limited the fiscal space for investment in climate resilience, and the result is more climate vulnerabilities. If we present the relation between debt risk and the interaction between debt risk and climate risk only for the market access Arab countries, we can see we can see on the more exposed the country in difficulties like Jordan, Tunisia, Bahrain, and Egypt. And Egypt, this country have a high level of debt and limited fiscal space. Donc, then the cost of the inaction will be more generate more climate vulnerability for this country. On the other side, another group of country have a comfortable, have an advantage over the other Arab countries in the case of oil exporting, oil producing countries, and given the comfortable fiscal space and the low level of debt, this country have the ability to implement reform for climate risk, climate resilience. The question of DSI, for the DSI, we have the two approaches of DSI. The dominant approaches adopted by IMF and other organization leads to debt sustainability, which is fragile because is fragile because the level because is not resilient to extra economic shocks like pandemic crisis or climate change. But I think it's an urgent need to develop, to implement a broader and innovative approaches, which include SDGs, which include climate goals, and in the agenda of reform. And the result, we can have an economy with a resilient, which is resilient to both economic and extra economic shocks. And then the debt sustainability will be resilient to extra economic shocks. The problem is the gap between the DSI classical and the DSI augmented by climate resilience. This generated a gap, and we have a problem to finance the gap. The problem is without SDGs, without climate goals, debt sustainability remain under stress, because debt sustainability is a multidimensional function, is a multidimensional issue. So integrate climate resilience into debt analysis remain crucial for an appropriate assessment of risk of debt distress. Debt distress. The gap, the problem for the private sector to finance the gap, private sector is not attractive by the green project. We have a problem of profitability, and then government must offer an incentive and a competitive environment. For example, we can finance by innovate instrument like climate for debt swap, or this instrument requires reform, requires a depth on the system path, and require a credibility of monetary policy. Why the credibility of monetary policy? Because to avoid the objective is to avoid the risk to finance green project by money creation. And for multilateral requires requires reform, structural reform, and the depth in the sustainable path. So I stop there. Okay, thank you.
Thank you very much, Muaz. I think you touched a very important, I would say, topic, which is this debt distress and climate vulnerability. I think there is a clear causality between both, and I think if this causality is not dealt with, of course, the financing gap will increase over time. Of course, with the, I would say, the vulnerability of the region, the Arab region, toward climate change, we know it very well. Not, of course, the countries that can afford to deal with it, at least in the short run. I mean, particularly, I'm referring to the countries that are exporting oil and gas, but then with the lifting of the oil and gas from our economies, most probably they also have to think about diverse systems toward the diverse technologies, other technologies like renewables and similar to fill that a gap in the future. So they might even move to the right part of your graph if they don't prepare for the change. Now you mentioned this financing gap. I totally agree, and this also applies to all the regions, including the African countries. I think it would be interesting to do your assessment for other countries and see in terms of financing, and I've seen the latest report, we're talking about trillions for this financing gap for all the countries worldwide. And then, of course, this causality between debt and sustainability and climate vulnerability will only be reinforced if we are not going to reach the Paris target. So the more we are, I would say, diverting or diverging from the Paris Agreement target, the more this causality will be increased and the financing gap will increase. So I think it would be interesting to estimate this financing gap, and at a point in time, I really wonder who is going to be able to pay for all of this. Thank you very much for this assessment. And I would like to move right away into the program to Maria Ron Balsera. Maria, she is the interim executive director at the Center of Economic and Social Rights. She has served as the coordinator of the Tax and Education Alliance, which is a partnership of international and regional tax justice and education constituencies. I think this is also all the network of the Tax Justice Network. This is all related, in fact, to the the illicit flows that they are moving around the globe. So much money that could be captured to fill that gap, and how to fill that gap, and who can monitor this. The floor is yours, Maria.
Thank you very much for this invitation. I'm just going to share my screen so that you can see it properly. Okay, so I'm going to be talking about how debt justice and tax justice interplay with climate justice. So basically what we can see is that the climate crisis and its financing gap is something that we really need to be taken seriously. At least 5.4 trillion is needed annually to achieve the SDGs by 2030, but there is currently $3 trillion shortfall, so more than half, right? That in the COP28, we found that high-income countries were not meeting their commitments of $100 billion per year, which was the agreement in the Paris Agreement. And we see that $420 million was pledged to the Loss and Damage Fund, but this really pales in comparison to the $7 trillion given in subsidies and fossil fuels companies worldwide. So what we can see here is that although there is a big financing gap, the money is there. It's not being allocated where it should. So where is the money as well as in those subsidies? We see that the global tax abuse is calculated to be $480 billion every year. This is as you were talking about the illicit financial flows, right? So we see that the past tax reform proposals like the OECD, the inclusive framework that is being pushed with the two pillars approach has failed to adequately include the global south countries and have fallen short of human rights standards, as well as the consequences really negatively, particularly for the Arab countries and for Africa in particular, in terms of the taxing rights and how much they would be able to raise. And again, this is something that all countries should be really looking at, even if they have signed, to make sure that they don't ratify and they don't submit to the pressure from the OECD. What we really need is to have tax cooperation to take place at the UN, because it is a truly global forum where countries have equal footing. The UN Framework Tax Convention negotiations that are currently taking place in New York offer a historic opportunity to produce global institutional arrangements for fair and effective resource mobilization. I think it's particularly encouraging as well that it was the Africa group with Nigeria tabling this proposal that has already changed things as we have never seen before. And the chair of the bureau for the terms of reference for this framework convention is actually someone from Egypt. So again, this is something to be very proud of. So what's the tax justice and what does it matter when we are talking about financing? Well, tax justice actually serves several purposes. We can talk about the 5 R's of tax justice in terms of increasing revenue to fund public services, sustainable development, climate adaptation, and mitigation. Also, it is redistributive effect to curb inequality between individuals and between groups. And you can actually take this to the global level and also between countries, right? Also, if it serves the purpose of repricing to limit the public bads, such as pollution, such as carbon-intensive consumption or investment. So we can tax this more to disincentivize these activities. It also increases representation, and this strengthens the social contract and improves democratic governance. And this is particularly important now that we are seeing that the role of the state has been diminished, and we are seeing that everything has been privatized, and this accountability and this democracy is really suffering as a result. So it's a time to be strengthening democratic governance. And something that hasn't been touched, this is a more recent development of tax justice, is the art for reparation, right? How tax justice can help reparation to redress the historical legacies of colonization and ecological damage, and how climate financing can be really drawing on that of the historic extraction, particularly from colonial rules, but this ecological damage, because we see that the countries that have polluted the least over the years are the ones that are suffering the most, right? So in terms of tax policies impacting climate justice, we have seen that the EU's recently instituted CBAM has fallen short of human rights standards and could lead to billions in losses, particularly for African countries. We see that wealth and windfall taxes actually offer an opportunity to raise significant revenues. Some of the estimates consider that wealth taxes could raise up to $1.7 trillion per year, and windfall taxes up to $941 billion per year. Just to say that windfall taxes are no longer extraordinary. They are becoming the norm. So we should also be moving to excess profit taxes. But I think that this is particularly important in the area of climate financing because, again, energy companies and also banking companies that have been investing in energy, particularly in polluting energy, have been really profiting from all these crises, and they are really pocketing all the money that should be really used for climate adaptation, mitigation, and to be resourcing rights. So all of these are suffering as a result. We also see that the French and Kenya task force on maritime and aviation taxes offer a potential, a source of revenue, but it still remains to be seen whether it will work as a progressive tax towards climate change. And it shouldn't be a distraction for a more comprehensive, progressive fiscal taxes, like, fiscal justice package and progressive taxation. So in terms of the intersection of debt and climate justice, we see that on average, countries in Africa borrow at rates that are 4 times higher than those of the United States, and even 8 times higher than those of Germany. So we can see already these massive, massive differences. Currently, over 70% of the climate finance takes the form of debt, and that is primarily channeled into mitigation. 29 out of 69 low-income countries eligible for concessional finance under the Poverty Reduction and Growth Trust of the IMF are at the intersection of high debt and climate vulnerabilities. The debt to GDP ratio increased from an average of 68% to 75% 3 years after the extreme weather event. And we can see, that's what I have included, that graph at the bottom. So, the Center for Economic and Social Rights that I represent has a particular, we think that human rights have been underutilized in the sense of how we want to be repurposing the economy. And the human rights obligation for fiscal policies are clear, but they could be clearer. So we know that states have an obligation to use the maximum available resources to advance the realization of economic and social rights. These include current, but also potential resources. So they include illicit financial flows, and countries are obliged to report on that. Why are they giving away harmful tax incentives? Why are they not doing what they should to really prevent and end illicit financial flows, right? And this is not only at domestic level, this also includes extraterritorial obligations, because we see that particularly OECD countries are really enabling those vulnerabilities. They are really enabling the global tax abuse. And in fact, quite often, the IMF is really encouraging these really regressive forms of taxation, right? So we, like CSR, argues for a rights-based economy to guarantee the material, social, and environmental conditions necessary for all people to live with dignity on a flourishing planet. We need to increase mobilization across movements, working for systemic economic change, greater responsiveness of key economic governance institutions, and an improved policy environment then can occur. This is the last slide, and this includes some of the recommendations in terms of the reform in the global debt architectures while addressing climate change. We think that the current approach of financialization avoids aiding low-income and emerging markets in climate change efforts. Nearly 90% of the climate-related investment has been issued through loans and other financing instruments, such as equities and securitization. This also has the added disadvantage of having to make all of these investable. So really it's becoming patchy, and it's really shaping in a really negative way the kind of climate structures or projects that can be invested on, and they are really attractive for private financing. We really need better reforms that include debt cancellation, establishing a sovereign debt mechanism, a UN debt workout mechanism, and holding private creditors accountable. We would also support the Bridgetown Initiative call for an immediate repurposing on special drawing rights for climate finance to benefit countries vulnerable to climate disaster. So basically, as a rule of thumb, and just to finish, I think that we need we really need to question all this debt and private first solution, and we should be really looking at progressive taxation as a sustainable and human rights compliant way of financing climate justice. Thank you very much.
Thank you very much, Maria, to bring this perspective of tax justice for climate justice. And I can only agree with you that a global agreement on tax justice must be achieved. And it should be connected very much to the global debate on debt and sustainability. And obviously this might also solve the financing gap, which is now in trillions at the global level. And obviously we need to do more. So your work is very appreciated, and we will continue exchanging and having the dialogue to really push further this aspect of tax justice at the global level. So not only we're talking about the causality between debt and sustainability and climate vulnerability, but then if there is tax injustice, then there is climate injustice, and then of course debt injustice. So it's all connected to each other. Thank you again for bringing this perspective. Our next panelist is Federico Sibaggia. Federico, he is an IMF, International Monetary Fund, where he joined in 2023. He has a very interesting approach, and I had the chance to listen to Federico some time ago, and I give you the floor. So you give us your perspective, please, Federico.
Let me share the screen. Here you go. I hope you can hear me. Hi, everyone. And I hope it's not too much information so far. And the idea is to spur a little bit the discussion. So the idea of this presentation will be to challenge a little bit, maybe some of what has been already said, but also in light of I think we need to challenge this trilemma the IMF has come with in the last few months in the fiscal monitor that was published in October last year, given assuming that international public finance won't increase, given the high interest rates, given the context of war, that countries are deciding to spend more on defense rather than climate, the IMF came up with this trilemma, raising the concerns of some of the approaches towards climate policy that could put debt sustainability at risk due to the increase in public spending. And it's something that I've been hearing. I'm based in Brussels, and only 2 weeks ago I was at the National Bank of Belgium, where the governor was saying that climate activists had come up with this idea that the climate crisis would mean an increased role for the state, more public investments. It was impossible. So that's where we have to challenge a bit. And also, I think what will be the risks entailed by some of these approaches that aim at putting private finance as a protagonist, and how actually those approaches also can put debt sustainability at risk. So I would like to briefly go through 3 case studies. I can share the presentation later where you will find the links, the relevant links. One is the case of Argentina, where we had a renewable energy program between 2015 and 2018, which was quite successful if the success criteria we measure is the percentage of renewables in the energy matrix. But actually what happened, I think it's a good example to show, the relationship between the financial architecture, the debt architecture, and the type of energy transition that we want to have. Because after it was a project in which the International Finance Corporation which is a private arm of the World Bank, was involved, also MEGA and also the World Bank Group itself. And in order to make an enabling environment for private investments to flow in, one of the main recommendations was to increase energy tariffs and remove energy subsidies. So with the idea of trying to have like a double effect on creating a better environment for private renewables, but also to reduce fiscal spending. And of course, this wasn't the only policy that was taken in this sense. The other Ones were 20 years power purchase agreements denominated in US dollars instead of the Argentinian peso, of course, to protect the companies from the currency risk, priority dispatch, World Bank guarantee, special tax incentives for those projects that had national industry components. This was a condition that actually later was scrapped due to IFC recommendations. And actually what happened, of course, this program was really exposed to financial volatility, as it required international finance, as it was import dependent. And that's where in 2018, when Argentina went through its macroeconomic crisis, the program just stopped, and the fourth bidding round got no projects. Of course, in light of the poorness, on how weak the global financial safety net is and how poor the debt architecture is, that it wouldn't allow the country to ensure macroeconomic and financial stability from 2018 onwards. It's impossible to think of long-term energy strategies if we cannot guarantee debt and financial stability. Then we also have the case of Zambia, which was mentioned before, and I think there are bigger experts than me on this front. But actually, one of the biggest components of the external debt of Zambia that actually led to the huge crisis later was the IPPs, as you can see here, which are the independent power producers. This is a program that came back from the World Bank in the 80s and 90s, especially for fossil fuel-based energy plants, with the idea of if we ensure certain conditions for private companies in order to ensure their profit, those companies will invest. But at the same time, that's where we have to think what can be the macroeconomic and financial pressures that it can create, especially for the balance of payment stability. And even though, these fossil fuel-based IPPs were a big part and created a big macroeconomic, balance of payment pressure for Zambia, the IMF is still continuing to ask Zambia, to put through its green goal strategy to rely on private finance for its energy transition without properly addressing what can be the risk entailed by that. And again, how is it that if we don't have a better debt and financial architecture, the program will likely be really exposed once again to the consequences of international financial volatility. And now I wanted to, because something, the two main tools that the IMF has been given to countries and recommendations that the IMF has been given to countries in order to kickstart or to accelerate their energy transitions is, on the one hand, to increase to attract private investments with all these programs that you can see, but also through carbon pricing, which of course in many cases is the reduction of energy subsidies. What is it that we say? Of course, fossil fuel subsidies have to be phased out. There's no doubt about that, but there's a huge complexity around energy. Energy subsidies can be the consumer fossil fuel subsidies, the producer fossil fuel subsidies. We can even consider the special terms for IPPs in order to attract private investments. Actually, they're producer fossil fuel subsidies. What happens in general when the IMF is part of these financing arrangements together with countries? It generally asks countries to reduce the consumer fossil fuel subsidies, which have a huge impact on energy tariffs. And we've seen in the last few months the case of Pakistan, Argentina, Egypt also, on how is it that inflation it's spiraled by the removal of energy subsidies. And that's where we ask for energy subsidies to be part of a long-term energy strategy. Its removal mustn't respond only to short-term fiscal concerns. It actually has to be embedded in well-planned, with social dialogues, energy transition strategies. And that's why we'll see, and it was mentioned at the beginning, the Resilience and Sustainability Trust, through which the IMF is designing policy conditionalities orientated towards climate policy. And that's where the removal of fossil fuel subsidies is taking a really protagonic role. But also that where it's questionable, because the IMF has been asking for a reduction of fiscal spending for years and decades and decades. And actually right now they're saying they're doing it in the name of climate. And I doubt whether it's the role of the IMF to be taking that protagonic role in energy subsidies removal strategies. Of course, it's interesting to have the IMF go into finance ministries and posing this question and posing this discussion. But at the same time, it's really complicated. I'm in Brussels, so here with all the problems we had with the farmers, the subsidies, also what happened after 2022 when Europe subsidized the energy after the spike in prices for 700 billion euros. And at the same time was asking the Global South to remove those fossil fuel subsidies. So that's where it's a complicated question. And also it's necessary to question whether it's the IMF the one that should be leading that discussion or not. And actually here I put that I can later share in the chat the link to this document by the IMF on mobilizing private climate finance in emerging market and developing economies, which has, it would be incredible to see the IMF actually implementing many of these points, because in many cases, I mean, having its mandate into account of balance of payment stability, in some, and here are some, I mean, those in italics are directly quotes from the reports. And you can find the IMF calling for increasing domestic capabilities in low carbon manufacturing, understanding that otherwise energy transitions will pose a huge balance of payment risk for countries if they are going to only rely on imports of capital expenditures for renewables. The benefits, of course, of debt relief, the link between the debt pressures and extractivism, which is something that happens in the country in Argentina, but also in various countries throughout the world. And I think this here in the right are some of the risks that are really important to think of. One, of course, is related to the tariffs, as in order to attract private investments, the tariffs internally are increased. And of course, that means that we're excluding from energy or from the different services, the most vulnerable populations, which are still recovering from the pandemic, of course. And I think also on this question on if countries right now are facing this incredibly high debt distress, how is it that these countries will be leading, will be reacting and will be managing those risks by a huge increase of private financial flows into these sectors? And I think I will leave it there so I can discuss later.
Thank you, Federico. I think you raised very important critical points on the role of the IMF, and I guess that the role of IMF might need to be fundamentally rethought, particularly when we're moving into a global, I would say, economic order, which is also changing. So we need to also understand who are the actors who really also have an importance in different countries, and then how to ensure that every country is actually responsible for itself. You also mentioned the conditionality, and I think the aspect of conditionality might or might not have worked. I don't think it has worked really tremendously, as you explain, and also as the evidence shows. But then at the same time, empowering countries for their own future, which is in fact similar to all countries in the planet because of the climatic challenges, is essential, and we just need to increase transparency. This is actually what we need to work on, how to ensure that those countries can share the right information, and also the creditors, they have to share the information even before. I mean, sometimes even the creditors, they don't give the information before, because you have all this set of confidentiality clauses in contracts, bilateral contracts, which in reality should not be there. I mean, because we need to know what is going on there, because at the end of the day, this is taxpayers' money, particularly when it is lent by the public creditors. Now, if it's private creditors, it depends who is involved. But then this is also the pensioners, investment plans, which also private. I mean, at the end, all these players will have to be accountable, and accountability cannot come without transparency. And I think transparency is a key factor to all the debate of debt, and also in terms of the climate vulnerability. So thank you for your a critical assessment. And I think it also connects to the justice overall, the equal fair treatment at the global level, because up to now we might think of lifting certain subsidies for some countries, and other countries, they have even more subsidies than other countries. And I think we need just to have the same rhetoric to all the countries in the planet, so then we can act within the same framework, not in I would say diverse framework, depending on the strength of or the deep pocket of certain countries. So I think we need to really be serious about this. Thank you again. Our next panel, we still have 2 panelists, but I think we are really moving very nicely into the flow of discussion. I would like to give the floor to Yolanda Fernillo. Yolanda, she's the Policy and Advocacy Manager on debt justice at Eurodad. So you have done fantastic work, and I congratulate you once again on the assessment you did on debt swaps. I think we've seen that some of these solutions, they might be very, I would say, attractive when you hear about them. But then when you go on the practice and you see what they do, you might rethink what you want to do. So please, I think the floor is yours at this stage, and then we can discuss further.
Thanks a lot, Rim, and thanks a lot to EMEA for inviting us and for the kind words. I'm gonna also share the screen, and I'm gonna basically present some of the conclusions of that report on debt swaps that we publish. I would love to be able to comment on others' presentations, but I think it's better that I stick to the initial plan, which is talking about debt swaps. As you know, with the current context, we have many institutions, governments, civil society, even organizations, think tanks interested in promoting debt swaps. But debt swaps are not new. They have been there for many years now, and we can make an assessment on what are the things that have worked and what are the challenges or the concerns that we have in their implementation. This is part of a report that we published in December. So if anyone would like more information, I can share the presentation, but also the report. And as I say, there are different types of debt swaps, and what we saw in the past was mainly what we call bilateral debt swaps, so debt swaps between a creditor government and a debtor government. There are also what we call third-party involvement debt swaps, involving like a multilateral institution, like the Health Fund, for instance, or the World Food Program. But what is grasping the attention of many people these days is what we have called private intermediated debt swaps. These are debt swaps that are done via a debt buyback with financial markets. So they tackle bondholders' debt by buying back distressed debt in financial markets. I'm not going to get into the explanation of the different types. This is, for instance, the scheme that we have to explain the bilateral debt swaps, the third-party involvement, and then this sort of new, because we have some experiences in the 80s and the 90s of these private intermediation debt swaps, the buyback swaps that we are seeing in countries like Barbados, like Ecuador, like Gabon and Belize. These are complex operations which involve many different agents. And this is one of the problematics that the debt swaps, the debt buyback swaps have. As I say, I'm not going to enter into defining the whole process, but if someone is interested, I can explain a little bit later. So, for instance, focusing on this later type of debt swaps, as I say, they have raised a lot of concerns, basically due to lack of transparency, which is something that you have been working on, and I think this is a very important and valid point for all the cycle of the debt, including if there is a debt restructuring or a debt swap. the high transaction costs. I'll speak a little bit about that later. And also the issue of conditionality that Federico and you raised just now. So doubts about country ownership, and also the issue about community participation and civil society participation. Here are some information about the this latest debt swaps. One of the things that caught our attention was that all of the debt buybacks are done via what is called a special purpose vehicle. And in all of the cases, this SPV was set up in a tax haven. It is weird because for some people, Barbados, which is one of the countries involved in debt swaps, can be classified as a tax haven, but they used another one in Ireland in that case. But Ireland, Delaware were the places chosen for these special purpose vehicles. There is some data about what or how much debt reduction these last debt swaps have achieved. The one that has received more attention is the one in Ecuador, because they managed to reduce the debt in almost $1 billion, which is considerable. It is only 1.7% of the country's external debt. So then it's not so considerable. And well, we have other concerns about the case of Ecuador, but beyond the case of Ecuador, it is worth saying that the other cases haven't really provided a big amount of debt reduction, which is one of the main concerns or challenges that debt swaps are meeting. If we look at the history of debt swaps, the conclusion, and it's not only the civil society conclusion, it's there are academic reports, but also the IMF report on debt swaps, a report that Lazard did for the European Commission. The conclusion is that they are not an effective instrument to reduce debt levels. And this is an overwhelming conclusion from, as I said, very different institutions and very different perspectives. We made a calculation. This is not a very exact calculation, because there is not a tracking system or there hasn't been a comprehensive evaluation of debt swaps across history. So we combined different calculations by different authors, and we came to the kind of approximate number of $2.4 billion US dollars of debt treated through debt swaps in the last 3 decades. This is added up, as I said, adding up different calculations, and it is a very, it is an approximation. During the same period, global South countries, low and middle income countries, excluding China, paid more than $7 trillion US dollars on debt service. So we go from 8 billions to 7 trillions. So it's a tiny part. It's 0.11% of total debt payments during the period that the debt swaps managed to save or to treat, because in some cases it's not an exact saving. In comparison, debt relief initiatives like that HIP initiative or the multilateral debt relief initiative managed to deliver more than 14 times debt relief than through debt swaps. So I think this is the main conclusion. It's not the most effective tool if what we are looking for is tackling debt sustainability. However, debt swaps can be interesting tools in the cases where there is not a debt sustainability problem. There is a problem of fiscal space and getting access to concessional funds for investing in SDGs or for investing in climate action. So debt swaps should be seen as tools to free up that fiscal space for countries who don't have debt sustainability problems. The thing is that they normally liberate very little money, not that much. And some authors have been promoting scaling up of debt swaps, saying scaling up is the response that we need for debt swaps being more effective. Our assessment is that beyond scaling up, we need to focus also on quality and on the governance of the debt swaps. So issues like additionality, like the disbursement schedule. We have seen cases of debt swaps where the country, the borrowing country commitments to invest the part of the debt treated into, for instance, education investments. So the commitment of the new schedule on how they had to disburse the money on education projects was worse than the initial schedule of debt payments. So it put the country in even more fiscal constraint to be able to deliver on the commitments of the debt swaps. These are exceptional cases, but it's something that has happened in the past. Also, the use of local currency. So traditional bilateral debt swaps, one of the most important aspects that they bring, the added value that they bring, is that they transform what should be payments, debt payments on foreign currency to the creditors into local investments in local currency. However, this latest modality of debt swaps via debt buybacks, that aspect is completely lost. And then also the discount rates. Debt swaps obviously can come with a percentage of debt reduction, of actual debt, unconditional debt cancellation. And that is what brings more fiscal space and more support to the fiscal outlook of the countries. Another issue that has been raised, and it was, for instance, raised by Lazard in this report I did for the European Commission, is whether debt swaps are compliant with comparability of treatment. They are not. There has been theoretical proposals about debt swaps, including different kinds of creditors, but that has never happened. And therefore, when a debt swap is agreed, there is one type of creditor, bondholders or bilateral creditor, who is taking the burden, while the others are not. So it can be seen as a subsidizing other creditors not involved in the debt swap. In the present context, where China is the most important bilateral creditor, and China is not for the moment doing debt swaps, that is a concern for bilateral creditors, saying if we do debt swaps and China is not doing debt swaps, not everyone is doing the same effort. Another issue, and this is also shared by all of the analysis, is how costly, how slow, and how complex debt swaps are, adding into this transaction costs. We looked into different cases, and for instance, in the case of Ecuador, there is a difference between the interest rate that Ecuador will pay for the new debt produced to that they contracted to return the debt buyback, and the issued bond, the blue bond issued for the debt buyback. And there is a 1.33% of difference of interest rates, that it is the amount that will cover for these transaction costs. As I said, there is a lack of transparency, so we don't know exactly what costs are involved in these. In the case of Belize, which it was produced a little bit before, and there is a little bit more information, only $84 million of the more than 500 million treated went to actual marine conservation, so 84 million, and the transaction costs were $86 million. So it's almost the same amount invested in marine conservation that was the cost of the whole operation. And then these are costs to cover the involvement of several agents that in some cases are not taking any risk because of the existence of guarantees and credit enhancement and credit enhancements. you can find this table in the document, which is a compilation of the different agents involved in this last 4 cases of debt swaps with debt buybacks. It's just an example of how complex and how many actors are involved in the operation, obviously bringing the costs of the operation up. Other issues and challenges that we found in the research is the issue of conditionality. Obviously, creditors involved in a debt swap want to know that the freed up resources are going to go into a certain investment, being climate, education, health, and therefore, if it's not led by the borrowing country, then there is a breach of sovereignty. As I said, lack of transparency, insufficient community and civil society participation. This is particularly relevant because in the past, in the 80s and 90s, we saw several cases and experiences where indigenous communities and local communities were excluded from their lands in cases of debt for nature swaps and conservation projects, the denial of access to traditional lands and resources, displacement of communities, etc., etc. So this is a lesson from the past that shouldn't be repeated in the present and in the future. As I said, there is a lack of systematic monitoring, so difficult to assess, for instance, the amount of gains from debt swaps, but also lack of evaluation of impacts of debt swaps. And this is something that we find particularly worrying. There is also risk of greenwashing, or what we could call blue washing, which has already happened in these last cases. In the case of Gabon, there was an issuance of a blue bond that even ECMA said it couldn't have the label of a blue bond because not a single dollar of the issuance of the blue bond was actually going into the marine conservation, because the 100% was going to the debt buyback. There was a commitment from the Gabon government to invest in marine conservation in order to access the operation, but none of the money raised in the blue bond was actually going into marine conservation. And then finally, also the issue of illegitimate debt and how debt swaps can be used as a means of legitimizing what we can call reckless debt or debt linked to corruption or illegitimate debt. As a conclusion, and I'm closing here, it's not effective. They are not an effective tool to deal with debt distress, with unsustainable debts. They can be, if well defined and well prepared, an interesting tool to mobilize additional funds. The additionality is very important. Not all the debt swaps are the same. So we're talking about debt swaps, and there are very different types of debt swaps, and bilateral debt swaps don't have anything to do with this private debt buybacks. As I said, several concerns to be addressed in the issue of disbursement modalities, local currency, ownership, transaction costs, transparency, accountability, civil society participation. So the quality and the governance of the debt swap is as important as the scaling up. At least this is how we see it. And then finally, debt swap shouldn't be an excuse not to deliver on debt relief, on actual debt cancellation and debt restructurings that many countries need. And debt swap shouldn't be an excuse not to deliver on ODA and climate finance commitments. And debt swap shouldn't be an excuse not to deliver on the reform of the international financial architecture and the debt architecture. The common framework is not working. Rim was said in the presentation. We need to tackle that issue. And all this focus in debt swaps for us is taking the attention out of where it should be, which is the actual multilateral debt resolution mechanism that the world needs. So all the efforts made in debt swaps, even if in some cases they can be helpful, is taking the attention out of where the effort should be which is this need for structural reforms in the international financial architecture. I'm gonna stop there. This is a quote from a statement that we work together with different organizations, more or less summing up what I have been trying to present and what is in the report. Thanks a lot.
Thank you, Yolanda. I think you gave us very good assessment of on this debt swap, but I would add one aspect which probably would also warrant further assessment from your side. Is the valuation of the debt to be swapped. It's not so straightforward, and it is subjected to bilateral agreement, which may not be transparent and based on market value. So we don't know what's going on. So this is also something which, in fact, should be taken into consideration. I mean, of course, this type of swaps are extremely complex, I can assure you. I mean, particularly when the debt can be maybe legitimate or illegitimate. We just don't know. That's one. But also, it's very interesting in your in your table that the bank which has led those transactions is Credit Suisse, which in fact, as you know, has been the heart of the fallout of the Swiss financial system in the previous crisis, banking crisis that we had. So I would be quite concerned about this type of instruments, and for sure, scrutiny is very much needed. So our last panelist is Carola Mejia Silva, who is a coordinator in the area of debt and climate at the Latindad. So Carola, we had the chance to meet in the COP previously. So what do we expect from COP29 based on what you heard, and what is your position as Latindad and overall in this topic?
Well, first, on behalf of Latindad, I want to thank EMEA for the invitation. It's so nice to see you again, Reem. And as all the previous speakers were mentioning, there is a very strong relationship between the debt and the current climate crisis that we can summarize in 5 points. First, the implication of the debt service payment in climate action. It is really reducing public resources for mitigation and adaptation. The world's poorest countries are paying more than 12 times as much to their creditors as they are spending on measures to tackle the impact of climate change. Second, climate action and energy transition will need more funding. We know that the amounts are really high, and this could increase debt, of course, but also much of the losses and damages that are being caused right now due to climate change are being covered with more debt, considering the limited fiscal space our countries have and the absence of a loss and damage fund in operation. This fund has been approved, but the time that is going to take for it to be implemented could be long. Third, there is more pressure on global south countries to overexploit natural resources to guarantee this debt service payment, which includes extractivism in this vicious circle regarding debt and climate. For the correlation between climate vulnerability, fiscal risks, and borrowing costs is very, very unfair, considering that the higher the climate vulnerability of a country, the higher the borrowing cost. And fifth, the implication of climate finance flows, as we heard, in debt burdens, considering that 72% of current climate finance flows are being delivered through loans. We started hearing more about debt and climate and the need to reform the international financial architecture since 2022, with the interventions of Mia Motley from Barbados in different UN spaces regarding the Bridgetown Initiative. And in COP27 in Sharm el-Sheikh, there were a lot of low and middle income countries raising these challenges related to extreme climate events, high levels of debt, and one specific case is were the floods in Pakistan, for example, that year. The solution that Pakistan received that year were more loans. And do you know what is the current situation of Pakistan now? According to our colleague Farouk Tariq from the Global Campaign on Debt and Climate, Pakistan debts reached $271 billion in 2023, with a per capita increase of 36% in 12 years. So it was like putting some gasoline in a fire. It only made the problem worse. And last year at COP28, these topics were also present, mainly from the demands coming from global south countries and groups like the B20, the most vulnerable groups of countries, and also civil society. We were very present there, from the debt justice movement, the climate movement, that started to work together. And that is a very positive thing that happened these years. We started working together, not only in advocacy efforts, but also in research, in raising some proposals. And that was very present in COP28, especially in climate finance negotiations, because countries were and are discussing right now a new climate finance goal under the new collective quantified goal process that will replace the $100 billion pledge that was unfulfilled. This year, in COP29, they are going to set a new climate finance goal. And these discussions are going to be very, very important this year also, in 3 technical dialogues that are going to happen, and also discussions between ministers of finance, of environment. So these discussions are not only about the quantum of this commitment, but also on the quality of the current climate and future climate finance goals, climate finance flows. And therefore, Latin-Dad and other CSOs and many global south countries are demanding to increase public grant-based funding, especially for adaptation, and of course for loss and damage, which was also a very important topic last year, because the new Loss and Damage Fund was approved the first day of COP28 with some details about its implementation. But as I mentioned, it could take longer to be implemented. And it is already including instruments like loans, for example, which we consider completely unfair. And even though there were no good news regarding climate finance and debt, there were some initiatives presented in COP28, for example, the announcement by the governments of Colombia, Kenya, and France about the group of experts that will work on the issue of debt and climate crisis towards COP29. They are supposed to present some recommendations, some analysis, and some results regarding these topics. And there was also the announcement of an initiative by the Multilateral Development Bank to promote more debt for nature swaps, which was immediately criticized by Latin-Dad for not representing a structural solution and for wanting to benefit the private sector, which, as Yolanda mentioned, it is very involved in these new mechanisms that are being used for debt for climate swaps because they are intermediaries. And finally, the text of the final decision of COP28 included some calls to increase the use of concessional and not debt financing, and also on reforming the international financial system, which was also a call present in the decision of COP27. So everybody's discussing about this, but the proposal that the global north countries are promoting is more aligned to a stronger role of MDBs, of multilateral development banks, in mobilization of climate finance, more participation of the private sector. And of course, we see a lot of risks regarding this. For example, MDBs are still funding fossil fuels. They are still funding mainly through loans. 91% of climate finance that they mobilize is through loans. So having a strong role of MDBs is not necessarily a good news, especially considering the inequality in the governance of these institutions. That this year, many of them, for example, the World Bank, the IMF, are going to be going to celebrate their 80th anniversary, but right now they are really not responding to the current situation of multiple crises. And a developing country will never be able to get out of this vicious circle in which the only alternative we have is to restore to more debt. For example, more loans or more of these green sovereign bonds that are being promoted, or which are more debt for the country, negatively adding to this dangerous situation. COP29 will be focused mainly on climate finance negotiation. This year is going to be key. The discussions regarding climate finance are going to be key because a new goal is going to be set. there's a lot of distrust between Global South and Global North countries because of the unfulfillment of commitments, the intention of diluting the historical responsibility Global North countries have. And this new group of experts are going to present some recommendations. And we really expect them to hear the demands and proposals of civil society. We have been working on this for many years, and I think it will be very important to consider some of these proposals. For example, I will show a slide. It's just one that summarizes some of the proposals, especially considering the debt situation and the limitations of the current UNFCCC financial mechanisms and the needs of low and middle income countries to tackle the climate emergency, which we heard are around $5.8 and $5.9 trillion until 2030. So we need to really start thinking about different solutions. Debt relief for countries in need is of course something that should be core, and it should involve private and public creditors and also MDBs, because MDBs are very important creditors in countries like mine and countries in Latin America, and I'm sure in other regions. Also the moratorium and debt restructuring for countries affected by adverse climate-related events and immediate access to non-debt generating resources to cover loss and damages. We don't want the same response as happened with Pakistan, for example. We want the reformation of the current climate finance architecture, leaving neocolonial instruments behind and increasing the use of accessible and agile public grants, especially for adaptation and for loss and damage, as I mentioned. We are calling for the reform of the international financial architecture that could lead to a more democratic and fair financial system. We really want a reform in the economic governance, in the quotas of these multilateral institutions, these financial institutions that are ruling the world. And also we propose, as Maria and also Yolanda were mentioning, the multilateral legal framework and then under the United Nations for addressing sovereign debt crisis. We acknowledge that the United Nations is the only multilateral really organization or institution that could solve these kind of problems in a fair way. We call for a new allocation of SDR, special drawing rights for climate action, and Latinda has presented a proposal in COP28 to consider new allocations of SDRs as new climate finance instrument. It is not being discussed yet, but we consider this important. But of course, under a fair distribution criteria, that would be something that we will add. We are calling for green taxes, especially to fossil fuel corporations, which are making billions of dollars every year, harming the world. We want the redirection of military expenditures and fossil fuel subsidies for climate action. The gap is huge regarding what is going right now on public money to the war, to fossil fuel subsidies, and fossil fuel investments as well. And regarding climate for debt swaps, I'm not going to mention much about this because already Yolanda already mentioned, but we don't want them to prioritize the interests of private intermediaries, and they should be really built under some principles that have fairness, transparency, and respect in the core. And we want to consider the ecological and climate debt of global North countries and the need for reparations. This is a call that we will be defending and demanding in all the spaces that we participate, because it is not about solidarity between the North and the South. It is really about reparations and justice. So I will stop there. Thank you very much.
Thank you, Carola, and I would like to thank all the panelists. I see the time running, but I have one question to all of you based on this very rich discussion. If you would please switch on your cameras so we can go on a panel screen. First of all, you heard our proposal, which is the proposal we had at the beginning of this webinar, to give the possibility to different players to solve the problem at a lower cost, and this is feasible, but then also it presumes the full responsibility of the borrowing countries. We also heard the solution proposed by Martin, in their work on how to deal with the gap and also how to deal with the increasing debt and external debt. But then this is also part of what we call restructuring plans. We also heard Muaz's assessment on the loop between debt vulnerability and debt and sustainability and climate vulnerability, so the two together. We heard from Federico and Yolanda that it's not working. I mean, the IMF plans are not working. The debt swaps are not working. Also, we heard from Maria that we need to do much more on tax justice. So what to do? I mean, what do you think of our proposal? In fact, still we need to use IMF. I mean, they have a trust fund, but in my view, it still belongs to the framework of the past. So probably it needs to open up a bit and give the possibility to countries to also take their future in their hands, but then with transparency. I mean, this is one possibility. And at the same time, reduce the cost of borrowing. I mean, we cannot expect that the borrowing, a trend will decrease because, I mean, this is one way to finance your economy, but then you have to be sure that you are servicing your debt at a lower rate. So how to decrease that rate, but then at the same time, how to ensure that this debt ensure the multiplier effect for growth, development, and funding the mitigation adaptation plan. So my question to you, do you think the proposal that Sandra made at the beginning of the panel would be maybe one part of the solution? And I would start from the end, from Carola. What do you think? And very quick, please, because we need to close at 5.
Yeah, I think it's interesting. The proposal you presented is very interesting, but as you mentioned, there are a lot of challenges and we really need deep reforms. Not only something at the short term, we really need deep reforms, considering that we have very few years to really solve or stop the climate emergency. Right now, we are not going to stop it, but we can at least control it. And in this situation of high indebtedness, it is going to be very difficult. So we really need another different solutions. I consider, for example, the participation of the private sector should not be only giving more lending, but really participating in debt relief initiatives, because right now they are very important creditors in our countries, for example. Also the MDBs. And yeah, I will stop there. Thanks.
Thank you. Federico, what do you think?
Great, thank you. I mean, and this is the organizational approach we have, that in the case of the private sector, the idea would be to have a disciplining approach to ensure there's 1.5 transition plans for the financial sector, and in that way, we get the private sector on board. I'm a little bit skeptical about using public money to de-risk private finance. Of course, I mean, we're speaking in an ideal world. We're not taking into account the geopolitical context when saying that. So that's why I don't cancel any solution. I think all of them have to be addressed. As I said before, I'm only, the focus of our work right now in the discussions is to ensure that we don't take private finance as the silver bullet. Thanks.
Thank you. Maria?
I completely agree with Carola and Federico, and I think that we really need to be thinking outside the box. We cannot be thinking that only trying to, to bring more like concessional debt, which is the idea, is going to really solve matters. We really need to be raising resources at domestic level and at international level through progressive tax reform, and really don't think that the private investment is going to be the solution. I really think that this is a false solution that is going to create more problems, and we are going to see it, and we have seen it in the past as well. So thank you.
Thank you, Maria. Yolanda?
Yes, I agree with Carola, Maria, and Federico that we need. I mean, we need a battery of proposals. I think the issue of debt transparency is important, but it's not a silver bullet. The issue of access to concessional finance is important, but it's not a silver bullet per se. we need an effective debt restructuring mechanism. Only by de-risking debt refinancing with the private sector, what we're doing is kind of kicking the can down the road, as we say. And if we don't take that time to build an effective debt restructuring mechanism, we will gonna have a problem in a few years. So even if we manage to, with de-risking and refinancing debts today, to avoid a series of defaults, we know that the crisis is already there. The development crisis is already there, but the defaults will come down the road if nothing else is done in terms of domestic resource mobilization and other things. And we need a functioning debt resolution mechanism. And I think trying to avoid that difficult process is not going to help anyone. So there is a battery of solutions. And just one thing on debt transparency, because I think we normally put the focus on the borrowing countries. And there is a lot of responsibility of the financial markets, of the private lenders, of the public bilateral lenders, not only China. I am from Spain. The Spanish government explicitly denies the possibility of publishing the conditions of the loans that they give to Global South countries. This is public money from the Spanish government to public institutions. So not only China, not only the borrowing countries, but the private sector and other bilateral lenders and the IFIs, who are kind of the most transparent of all the creditors. But still, we have been waiting for years for the IMF to publish the data on surcharges. We need to demand full transparency from these public institutions particularly, but from all the creditors as well. And as someone said in a panel last year, if they refuse to be transparent, then they cannot claim their money back. And that should be the rule. And we should be very strict with that.
Okay,
Thanks.
I absolutely agree with you, Yolanda. It's transparency requirement on both creditors and lender and the borrowers. So I think these are very important. Muaz, would you like to add anything to the discussion? You're muted. You're muted.
I agree with all the idea presented, but I can say it's important to anchor the culture of transparency in the debt management. It's important, and other for the instrument uses or presented today. Perhaps it's better to know the prior action for even instrument to go, and which is necessary to take to go for the good direction. Because, for example, climate debt swap, we have money criticals, but like one that presented, there are prior action to take if for have the good result.
Thank you, Muaz. Martin has left, and Sandra, the last word, it's yours.
Thank you very much for your input. Indeed, the need for deep debt restructuring is important. And the idea of using public, I find very interesting your point, Federico, to use public money to guarantee private money. But at the same time, it's also been done for SMEs and it's been successful to finance SMEs. So you have a good point for this, but it's been done also in different mechanisms. And yes, so thank you for all your input. We will try to add them also to improve the paper that will be published very soon, hopefully.
Okay, I think we are at the end of our webinar. Thank you very, very much for your input. It has been a very rich discussion. it really shows that I mean the interlinkages between debt and climate. We need to continue working on this. The solutions are not obvious, and then I would say the diversity of the countries and the different models of financing that also makes it much more complex. Of course, innovative financing is great, but we need to put this under scrutiny. And as you said, Yolanda, I think the debt swap, in my view, might have been appearing as a solution, but when one looks at it with more, I would say, with deeper analysis, this might not be the case. It's costly, and it might even raise further challenges in the future. Of course, I don't see a solution where all the stakeholders are involved. I mean, public, private, countries, debtor, creditors, taxpayers. But then the central part of this is to enhance transparency. And again, we need to continue working on transparency and really rethink conditionality, but then not rethink conditionality, not to have any alternative, because we still need some sort of accountability, but then accountability comes with transparency. At least this is what we know today. And thank you again very, very much for your contributions. This webinar is recorded, so it will be accessible freely to everybody. And then we will have a report, which will be published at the Euro-Mediterranean Economies Association website. So thanks again, and we will meet for other occasion. Thank you all.
Thank you, everyone.